Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. Well, it's finally happened. Warren Buffett has announced his retirement. He announced at the Berkshire Hathaway shareholder meeting this weekend that he will step down at the end of the year. Greg Abel, the head of Berkshire Hathaway's energy operations, will become the CEO of Berkshire Hathaway. Berkshire Hathaway is, of course, the company, the conglomerate that Warren Buffett built, turning a failing textile mill in Massachusetts into a conglomerate led by insurance and other companies, energy, See's Candy, just a wide array of companies that seem in some ways unconnected, except that they're part of Berkshire Hathaway, led for so many years, since 1965 by Buffett and up until recently Charlie Munger. We should note Buffett's record for the time he ran Berkshire Hathaway from 1965 through 2024, at the end of last year. Buffett amassed a 19.9% annualized return versus 10.4 for the S&P 500. That is astounding to add that many percentage points to the S&P 500's return for multiple decades. If you think you will find an investment manager to do that, even over a 10-year period, you'd be hard-pressed. Don't hope for anything like that. And Buffett's advice, of course, to investors in his shareholder letters in recent years has been to just invest in an S&P 500 index fund. Buffett took questions, as is customary at the meeting. He did speak a little bit slowly, and it looked like it was ready for him to step down. He's now at 95. He was born in 1930. Jason Zweig of the Wall Street Journal, of course, had a brief review of his career and gave 3 reasons why Buffett is unique. And the first one is just the person himself. Buffett really enjoys reading financial statements for hours at a time during the day. That's how he likes to spend his time. Not many people like to do that, but he does. And so always remember that if you think you have a hunch about a stock. I like to remind clients about this. You're competing against Buffett and others who are at least a little bit like him. I don't know that anyone is completely like him, but you're at a disadvantage, and most people don't realize that. They have a certain bias about their own ability. Everyone thinks they're a good driver, for example, or they think they know something about a stock or the business behind the stock and that stock should go up. If you haven't spent hours upon hours studying a company and you're competing against people who do that for a living, you're in trouble. Have a more realistic view of your own abilities, and maybe you have the capability to do that, but if you haven't spent your time that way, if you have another job and you just don't have the hours to put into it, you may have the intellectual capability, but if you're not devoting your intellect to that, you're not going to be able to compete. So the second thing is the time during which Buffett invested most of his career. The world wasn't invested in stocks, or the country wasn't invested in stocks the way it is now. The 401k was developed in the late 70s, and the amount of money going into the stock market for a decent part of Buffett's career wasn't what it is now. People weren't, there weren't armies of people studying every company every single day the way they are now. And the third reason Zweig gave for Buffett's success was the kind of vehicle he chose, a company itself that he turned into a conglomerate that he fully controlled, basically, that didn't charge fees to investors, that didn't have to worry about inflows or outflows of cash, investors yanking their money, pulling it out when they thought he was doing badly, and then throwing it in when they thought he was doing well at odd times. And so I think that's not totally true in the sense that the company got so big, it's got $1 trillion market cap now, that Buffett probably did find it harder to put money to work over the last decade or two than he did earlier in his career. It was just too much money to deploy, probably. And if he had lived longer, he himself said his returns might have mimicked more those of the S&P 500. Noteworthy also, I'm not sure if Zweig mentioned this, that Buffett is sitting on over $300 billion of cash. And so it's funny, people, they have a hunch about a stock, and they think they can pick stocks. So they compare themselves to Buffett in that way, but they don't notice that at various times he has sat on an awful lot of cash when he hasn't found anything to buy. So those are a few things about Buffett. It's worth noting also that during the shareholder meeting, Buffett criticized current administration, the tariff policy, and that made me think that economic conditions have been good for owners of capital and asset owners in recent decades. And this isn't so much a comment on the current administration, but the current administration, and maybe those that follow it, regardless of the party, may see fit to make conditions less favorable for owners of capital. That might not be a bad thing politically, but it might not be such a great thing for owners of capital, for owners of assets. And investors should think about that a little bit, that things have maybe never been so good for owners of assets. The capital gains rules, just all kinds of rules. Rules allowing companies to merge with each other. Some people think there's a monopoly problem. All of these things might change in coming years, and investors should consider that returns on invested capital may not be as high as they've been. I like to use the example of the part of GDP that is corporate profits. For a long time, it was 6%. Buffett actually commented on this in a Fortune magazine article some decades ago. For a long time in the post-war period, the part of GDP that was corporate profits was 6%. Now it's up over double digits, and it has been for at least a decade. And that just means more money that's being produced is going to owners of capital than it is to labor. And I think there have been political problems that's caused, and that situation may not persist. Whether it's the current administration's tariff policy or other policies that other administrations might implement. The Biden administration had a very strong antitrust regime, for example. So there are all kinds of fronts on which political leaders could attack the profits benefiting capital more than labor. So those are the thoughts that I have on the weekend of Warren Buffett announcing his retirement at the end of the year as the head of Berkshire Hathaway. So this is John Kamarianos for Capital Considered signing off. Thank you for watching.